Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gertis, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Recon Group at West USA and the Frederick team with Fairway Mortgage. NMLS number 625918.
Obviously, we focus on the side of building wealth in real estate. And one of the things that you're probably, if you own a home, probably one of the things that you'll never hear or your real estate agent's never going to talk to you about because they're not thinking through the prism of helping you build wealth in real estate. I am a firm believer that every single homeowner should consider having a HELOC or a home equity line of credit on their home.
HELOCs equal liquidity. So one of the big issues that people have with real estate is that they say, oh, well, if I need to sell an asset of mine from my real estate portfolio, chances are I'm looking at a 30-day escrow period. That's not nearly as liquid as pulling a $100 bill out of my pocket and exchanging it for goods or services, right? But if we can front load that work, so if you own real estate, and I don't care what it is, if it's your primary home or if it's an investment property that you have down in Mexico, you want to make sure that you have a HELOC available on there so that you have those assets available should you run into another opportunity to develop your real estate portfolio even further.
All right, Justin, just pretend that we are fifth graders, but it's not a far stretch, right?
I got you there.
But for the listener that is not familiar with the term home equity line of credit, and of course HELOC is short for home equity line of credit, and I know that your company and your team is starting to offer our clients the option of getting a HELOC through you. But dumb it down, what's a HELOC?
It's essentially like using a credit card against your equity in your home. So let's say you owe $200,000 on your primary mortgage and your home value is worth $400,000. Well, the equity between the amount that you owe on your first mortgage and the value of your home, that's considered equity. So you're able to use that equity up to a certain point to leverage for whatever you need, as long as you qualify for. But the big thing about home equity lines of credit is they're portfolio money, again, just like jumbo loans. So each lender has different guidelines, terms to it. For example, there's a lot of lenders out there that will loan up to 90% of the home's value for a primary mortgage, and they won't lend on second homes or investment properties. There's lenders out there that will loan on investments, seconds, and primaries, but maybe only up to 80% of the home's value, maybe 70% on the investment property. Some of the lenders within home equity lines of credit require you to take out the full line of credit on your initial draw. Some of them don't require you to take out anything. Some will have a minimum draw of maybe $25,000. So there's all sorts of different rules and guidelines out there. Some of them you pay closing costs on. Some of them you don't. It depends on what your situation is.
And some you pay annual fees and some you don't.
Correct.
And that's really the point of the matter is not all HELOCs are created equal. And if you'd like some information about looking into getting a home equity line of credit, whether it's on your primary residence or whether it's on a rental property, which we'll talk about in a few minutes, comes with a few little more curveballs coming across the plate, we want to encourage you to just text the word credit to 623-AZ-RECON. Again, text the word credit to 623-AZ-RECON. So, an example. I recently got a home equity line of credit because, Ryan and I always say we got to drink the Kool-Aid.
Yeah.
And I have a house in Scottsdale, and we bought several years ago, and we just watched over the last couple of years the equity go up, go up, go up, go up. I have a history of opportunities, real estate opportunities over the last 20 years I was not able to jump on because I just didn't have that kind of cash sitting in my checking account or my savings account. So that's why we advise every homeowner to, especially if it's your primary residence, look into the possibility of getting a HELOC. So the kind of HELOC that I got, I didn't have to take a lump sum out. I literally have it's not even a credit card. I got a checkbook.
Yeah.
Right.
You can do both.
And
It's
you can
great.
do both. So I got a checkbook. And so I don't know what my loan balance was. And at that time, my house appraised at a certain level. So at the end of the day, I ended up with a $370,000 credit line against the equity of my house. I don't have to pay, even though the interest rate's a little bit higher, or a lot higher. I don't have to pay on it. I don't do anything. It just sits there. But I now can go to bed at night or wake up in the morning and know when Ryan comes with some crazy real estate opportunity, which he tends to do.
I've been known to do it from time to time.
I now have access to up to $370,000 to jump on said opportunity. If I have this HELOC for the next 5 years and I never use it, my particular HELOC, I'm paying $50 a year just to have the peace of mind to be able, Ryan, to jump on these opportunities.
And I think that it's also important to say if you found yourself in credit card trouble, which I know we're going to talk a little bit more
Well, my son's in the studio, and he's like, Dad's got $370,000. I see the wheels turning.
He's like, we're going to Dubai, baby. I got you. I see you. If you have any other type of debt issues, whether it be credit card or personal loans, or maybe you just have a really high vehicle interest rate, it might even be a good idea to consolidate those things in order for you to get more runway for your real estate investing, because all those things can add up big time whenever it comes down to DTI, right? Because you're going to have this loan over here, this loan over here, this loan over there, and then all those different trade lines, they can affect what you are doing over there. So not only do you have that runway, you have the ability to do that consolidation. We did the same thing. We watched our equity grow and then took out a HELOC, and for us, we have, and then from most of the HELOCs that I've seen out there, they're all interest only. Mm-hmm. So if you need to get cash quick but not have to have a big monthly commitment, because maybe you are trying to ramp up something to maybe you're flipping a home, right? You're going to have that cash right there where you can close on it quick, flip it, and then pay it all back to where you're not going to have that huge monthly payment on it. And by the end of the day, it ends up just being kind of a drop in the bucket, because if you're using it properly, you can turn it into more cash.
And I try to explain to Mindy that the best use of our home equity line of credit is a fishing boat.
That's the worst use.
All right, if you'd like some more information about home equity lines of credit, and Justin's team can help you with that, all you got to do is text the word credit to 623-AZ-RECON. Again, text the word credit to 623-AZ-RECON. Justin, one of the first questions that I generally get is, why would I get a HELOC rather than doing a cash out refinance? And for me, there's no way I can't do a cash out refinance because my interest rate on my primary is in the low threes. The moment that even though a home equity line of credit, even though that interest only payment, that interest rate is really, really high, I don't want to refinance my entire mortgage and go from 3.25% to 7%.
So everybody's situation is different, and those different situations require different thoughts. But for you and your purposes, with you not needing the money, it's nice to have that home equity just sitting there. And I would recommend everybody having a home equity just sitting there that you don't have to draw on immediately if that's the case, that you don't need it for anything right now. But after you guys talking, I just want to throw out there, a foreclosure. A lot of these foreclosures are going to auction these days. You have to come up with the funds in 3 business days. There's no other loan out there other than a home equity line of credit or having cash on hand where you can obtain these types of properties. Mm-hmm. And there's a lot of people out there that are shopping for these. But back to your question there, and what was your question?
I'd like to add in there the going back to it's totally situational. So if you have a home for that cash right away, and it was 2 years ago, then hell yeah, you're gonna do a cash out refinance, because what's the difference between 2.75 and 3%? But right now we're talking about 3% jumping up to 7 and change.
Can't do it.
8.5 and change. So A home equity line of credit is based on prime, and majority of home equity lines of credit are variable rates based on prime. Now, typically, if you do research on prime, typically it's going to be a low rate on your home equity line of credit. Now, due to inflation, the rates are much higher on your home equity lines of credit. However, it should be for a short period of time. And when I say a short period of time, I'm talking like 2 years in that area.
Jump on an opportunity. That's how I look at it.
But again, jumping on an opportunity. How often are you going to get a chance to buy a house for $350,000 that's worth $500,000? Well, if you didn't have the money for it, somebody with the cash is going to obtain that and swoop it up. But there is fixed rate home equity lines of credit out there. They are higher interest rates, but in certain situations, those fixed lines at a fixed rate are a really good situation for somebody that, like we have a customer right now looking to buy another investment property, and he's looking to leverage another investment property. Well, the only option he has right now is to take a fixed rate up to a certain loan to value, and he's going to pay closing costs on this home equity line of credit, but it's going to allow him to keep his cash reserves in his pocket to expand his portfolio.
All right, if you'd like to learn more about home equity lines of credit and how Justin and his team can help you, all you got to do is text the word credit to 623-AZ-RECON. Again, that's credit to 623-AZ-RECON. Justin, I just want to really quickly, for the sake of time, just break down the differences between I'm getting a HELOC on my primary residence as opposed to I've got a rental property that's got a crap ton of equity, but I possibly want to get a HELOC on my rental property. I want to talk about the differences because this is what I tell everybody, especially if you're thinking about selling, how important it is, even if you don't use it, to get that HELOC prior to moving out, prior to it turning into an investment property, because it's a little more tricky when it's a rental property.
Yeah, when it's your primary residence, it allows you to stretch the line of credit. And I'll tell you, the reason why I tell you to get the highest line of credit that you can on a property as well is typically your higher loan amounts or your higher lines of credit give you pricing breaks on your interest rate. But if you're doing an investment property, you're restricted on your loan to value. Typically, we can get you up to 85% loan to value on a primary residence. Whereas on an investment property, you're probably going to be stuck at 75 to 70%. And there's a lot of banks out there that are just outright stopping home equity lines of credit on investment properties. We had only a handful of them, even when things were doing well, and rates were low. And now we're down to about 2 or 3 that will offer home equities on investment properties, and you're coming with higher rates.
Now, Ryan, it's a really interesting conversation we have in wrapping up because we are different. We differentiate ourselves by being real estate wealth managers. About all of our discussions with our clients, with our listeners, is truly we see things through the prism of building wealth in real estate. And it's been a while, pal. It's been a long time since you and I have actually been on a listing appointment together. Okay, so I don't know.
Right.
I don't know what you do, but I'm going to go ahead and speak for you. But one of the first things
you're going to answer the question for me that you're asking.
You just sit there and be quiet. I'm going to put baby in a corner right now. But one of the
so we're going to listen to Mike talk again. Is that okay? All right. Gear up.
I love the sound of my voice.
I want to hear what he has to say.
Yeah. Shut your mouth.
I had someone tell me the other day. They said, why is Mike always such a dick? And I was like, that's just because he's insecure. So this is one of those moments. Go for it, buddy.
No, but when you talk about the differentiating factor of all the other real estate agents, typically when I show up on a listing appointment, when somebody raises their hand, when somebody calls me and says, hey, I'm thinking about selling my home, obviously we're going to talk about Reconomics. Obviously we're going to talk about how does this house look as an investment property, but do you have a HELOC on your home? And they're like, I don't know what that is. And they've talked to so many other real estate agents out there. I'm like, do not move. Do not put a sign in this yard until we've locked down that HELOC because of the opportunity it's going to present and how challenging it is if you wait till after you move out.
And one of those other idiosyncrasies are if they see that your home is listed or has been listed recently, they'll give you a big thumbs down whenever you're submitting your application too. So
Good point.
Before you sign anything, get that, like you said, get that HELOC over there and create that runway, because you don't know. You could wake up the next morning and say, you know what, that Mike and Ryan guy, they know what they're talking about. Let's go get some more money out of this property before we liquidate it. So it's for us, it's $50 a year. We don't carry a balance on it because we only use it whenever we need it, and then whenever we do use it, it's usually to flip something, so we're paying it right back within 90 days or less. And so we're paying very little interest, and then $50 a year to maintain the account. So what do you have to lose?
All right. If you would like assistance, you'd like to have a discussion about HELOCs and your options to your primary residence, or if you're looking at a HELOC for an investment property and you want to talk to either ourselves or Justin and his team, all you got to do is text the word credit to 623-AZ-RECON. Again, text the word credit to 623-AZ-RECON.
Thank you for joining us on the Real Estate 401k Show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623-AZ-RECON.